Hello and good day to all our viewers. Welcome to Market Watch. My name is Pasantu Pereira.
And hi, my name is Usama Jeffrey.
Well, Usama, if you look back the last 2 weeks, I would say the most important weeks for both global market and the local market so far in this year. If you look at the global context, we have seen the US interest rate increase happen in the last March 15th through the FOMC meeting. And in the local context, we have seen the last Friday, the monetary board decided to increase the policy interest rate by 0.25%. So in this particular context, Usama, how do you look at the US rate hike and what does it look like and what the message that can be passed to our investors? If you can just brief the background on these things, Usama.
Well, looking at the history of the Fed rate, particularly when it came to the US financial crisis during the 2007 period, which they had a high interest rate of about 5.25%, the Fed required to reduce the interest rates in order to stimulate the economy itself. And over a period of time from the 2007 period, when it came towards December 2008, they managed to reduce the interest rates down to about 0.25%, which helped stimulate the environment and meet their twin objectives of unemployment levels as well as the price stability.
Right.
It was at this point that the turnaround also happened with regard to the interest rate, where the hikes started to come in. We saw 3 hikes over that period from the 2008 right down to the 2017 period. Initially, we saw 2 rounds of interest rate hikes of about 25 basis points over the periods, where the Fed did meet its respective objectives. And in the most recent, the March 2017, we did identify another 25 basis point increase, which was directly as a result of the increasing number of job seekers, the increasing employment levels, and of course the rebound in the wage rates as well. So which allowed the Fed to actually increase these rates across for the economy. Also looking at different perspective, actually analysts were even expecting rate hikes of even 50 basis points in the current context itself. But what the Fed gave, the idea that the Fed actually bought across by this 25 basis point increase was they are looking at a gradual incremental growth in the interest rates rather than an aggressive one, which is a very good point of view as well. So if you were to ask me what sort of expectations are there for the 2017 period in terms of an interest rate hike, what we can possibly expect is a continued growth in terms of the Fed rate, maybe about another 25 basis points in the respective 2 quarters to follow across as well.
Right.
So,
Usama, if you look at the emerging market perspective, especially the emerging market equities, what does it look like? What would be the impact like? What's your observation post US rate hike in this time?
Well, that's an interesting point as well, Pasindu. I mean, it's not exactly the gloom and doom position which everybody is actually anticipating as a result of the interest rate hike as well. Right. The main reason which you would look at that is if you look at the US equity markets itself, it is in a fairly overheated position. You look at the Dow, what happened over the last week, they lost about 1% in terms of 238 points coming down, and possibly as a result of profit taking due to the overheated conditions across over there. And even in terms of the S&P, what we noticed was a nearly 1% drop across in the index as well. So this is indicative of the overheated positions in the US markets, which of course is going to make alternative markets like for example the emerging markets more attractive to investors. Because the emerging markets also have a unique proposition in terms of higher return due to their emerging context, and of course offer diversification as well as risk reduction potentials across as well, which of course is attractive to the foreign investors.
Okay.
But that being said, an important point to also remember is from a foreign investor's perspective, one of the major concerns which they might have in terms of a factor which can erode their return is of course the exchange rate. So depreciating foreign currencies on a foreign investor's context can be seen to erode their investment returns. So what we are trying to get at over here is the main takeaway point, so to speak, is that emerging economies, countries will see hot money flowing into them, But of course, those countries which have a more stable interest exchange rate policy, I beg your pardon, will definitely have the more probability of seeing this hot money coming across into their economy. So what is your view, Prasindu, if you can just brief us on what sort of an expectation we can have in the Sri Lankan economy as a result of the changes in the rates?
Yeah, if you look at Usama, the last Friday, central bank monetary policy or rather monetary board decided to increase the rates by 25 basis points. I would say it's the first time where they increased the rates in for this particular year. But we have seen the last year 2 rounds of policy rate increases. If you look at the background why this particular rate hike came into the picture from the local side, especially Sri Lankan rupee has been under severe pressure. If you look at the foreign holding in the treasury bond market or the billman bond market has been eroded to 1.2 billion level, where we have seen that figure at $3.5 billion level in 2015. So it was a drastic reduction, and that has put enormous pressure on the exchange rate point of view. Further, if you look at the foreign reserve position in Sri Lanka has been eroded to $5.6 billion level, which has been the one of the lowest level we have seen in recent history. So that will further put the pressure on the currency, and that indicates something. The government or the central bank intervention on defending the rupee may likely to come down. If you look at further the government's debt repayment for the next one year or other 12 months time would be around $4.8 billion level, which is substantial. So these factors will put enormous pressure on the currency. So with that currency pressure, they'll have to, or other policy makers need to increase the policy interest rate. Having said that, the private sector credit growth is still hovering at high 20% level. If you look at the January figures, Usama, we can see around 20% private sector credit growth, or rather 21% growth still has been happening. So that will put the pressure to the exchange rate, and again for the inflation figures as well. If I just drill down the inflation numbers which released recently, actually which has been skyrocketed in a sense. 8.2% inflation was recorded. So one of the highest numbers where we have seen over the, we'll say, last 2 years rather. So if you look at the major factors why we have seen this inflation, number one would be the prevailing drought, which has put the supply side constraint into the equation, and number two would be the tax adjustments recently what we have seen from the budgetary point of view. And again, if you look at the core inflation numbers, which is also at a high 7.1%. Core inflation means we have taken out the more volatile items from the equation. So for example, food prices, maybe energy prices, but still we can see inflation number is hovering at a high 7% level, which is the highest level we have seen after 2013. So in this particular context, inflation figure is under pressure, or the inflation is under pressure. So it is likely to go up further because we are a festive season ahead, right? So with that, there would be a pressure on the demand side of the inflation as well. So with that, there would be a pressure on the inflation. So all in all, what we can expect is a sort of a overheated economy right now. So that's why, in line with the US interest rate, so they'll have to keep the rate high to defend all these particular problems.
So what can we expect, Prasindu, from a local economy's context, the expectations?
Yeah, if you look at the this recent rate hike 25 basis point, which will likely to affect the AWPLR or the market interest rates also, because if you look at the last year, we have seen nearly 1% increase in the policy rate, or rather 100 basis point increase, which resulted the market interest rate to adjust by nearly 400 basis point, or rather 4% in 2016. So with this particular 25 basis point increase, I'm expecting somewhere around another 1% or rather maybe 2% increase in the market interest rate. So that will take the AWPLR figure from the current 11.7 to, we'll say, 13 or the 13.5 level. So which is a possibility. If you look at the 2012, again a sort of a tightening year which we have seen recently, right? In that particular year also we have seen the AWPLR figure was hovering at, or rather peaked at 14.25 level in 2012. So 13 or rather 13% or 13.5 would be a possibility in this particular context. That will put the pressure again for the local the consumption patterns or rather consumption, and at the same time the local investors' behavior in terms of the capital investments, because at a high borrowing cost where the more domestic investments may be discouraged. So again, if you look at the economic growth prospects, Usama, what you have seen for the 2016 was again the 4.4% growth as per the provisional figures published by the central bank. The economic growth for 2016 was at 4.4%, which is a reduction from 4.8% which you have seen in 2015. If I just briefly touch on the drivers for that particular growth, especially the industrial sector, which was predominantly driven by the construction sector. And especially if you look at the construction sector, we know for the fact that government investments or the government investment infrastructure is absent for the 2016, relatively absent. So major driver was the domestic private sector or other private investment in the construction sector. With this particular rate increases where we expect the market rate to be adjusted, then that will put the pressure or rather that will likely to hinder the domestic investment in the construction sector as well, right? So at the same time, if you look at the service sector, also seen around 5% growth in 2016, predominantly driven by the telecommunication, financial services, and the insurance sector. And again, unsurprisingly, the agriculture sector saw a sort of a dip in 2016, especially the second half there was a severe flood, and again down the road in fourth quarter there was a drought, right? So this particular trend will further continue in the first half of 2017 also. Still the drought has been prevailing. If you ask me, Usama, can we see a sort of a reversal in the contractionary policy in this year? I hardly believe there would be a reversal in this particular year, especially the policies which we have seen or rather the pressure that we have seen for the macroeconomic point of view will further continue in 2017 also. So in a near term we can't expect a reversal in the policy point of view. Usama, if you go back to the CSE side or the Colombo Stock Exchange in this particular context, how do you see the sentiment of the Colombo Stock Exchange?
That's an interesting question, Pasinda. Actually, with everything which has been happening, of course, the market has had a bit of a negative sentiment looking at it. The All Share Index year to date from January to March has lost about nearly 4% on the index, whereas the S&P has lost nearly 2.5% on the index, which is notable as well. And even if you look at the activity levels in the market itself, the year-to-day daily average, if compared to 2016, which had about 737 million rupees worth of shares trading across in 2016 on average, that daily average has now come down to about 670 million, right, which is a near 9% drop in the activity levels in the market, which is probably the notable feature, the notable visible feature in the market. But also the notable other feature in the market which needs to be brought to notice is the factor of the foreign participation and the interest crossover there. If you look at the 2015 and 16 period, on average we would have seen about 44% participation in terms of the turnover from the foreign investors themselves, and that same trend continued across into the beginning of 2017 as well. But what we've seen over the recent past is that the interest of these foreign players have started to take a much more larger percentage of the turnover, and in fact it's moved up to, from the 44% averages, it's moved up to the 70+% contributions across into the turnovers. Right. And even if you look at the 23rd March concluded day, 77% of the revenue contribution did come from foreigners across over there. So once again it reiterates the fact it's not exactly a gloom and doom story across, right, but the foreign investors are looking at Sri Lanka as a positive market provided the valuations are good and etc.
Right. In this context, Usama, what would be the strategy should equity investor should hold on to, because this is a sort of a period where the capital appreciation is absent, I would say, due to this contractionary monetary policy. So what would be your strategy, like what the message that we can pass into our equity investors?
Well, they need to realize how the market is behaving and need to rebalance themselves so that they can adapt to that same context. Now, in the absence of capital appreciation, that particular source of return is going to be a bit of a question mark. Right. And as a result, they need to look at the next source of income which they can use to supplement their portfolios across, which is dividend yield. Yeah. And they need to be rebalancing across to fundamentally sound stocks which will give you a reasonably good dividend yield going across as well. In addition, it is also important for them to consider, looking at an overall portfolio perspective, how they are going to fit in high beta stocks across there as well with good fundamentals, because the idea is soon as the tightening measures in the economy will get relaxed, this turnaround in the market coupled with high beta stocks will stand to give a huge push across into their portfolios in that perspective.
Obviously, yes.
And the important factor over there is, I mean, we are looking at a longer holding period and we are looking at a higher risk perspective going forward. But provided they enter into these high beta stocks which are fundamentally sound and are giving you a high dividend yield, over that investment horizon they are looking for, the return which they can expect from both the capital appreciation as well as the dividend yield should be adequate to compensate for their risk tolerance which they are taking across in this possibly risky market going forward.
Definitely, yes. And if I just add something to you, Usama, if you look at the market valuation, it's pretty attractive. If you look at the PE numbers, market PE stand around 11.7 times as of today, or rather the latest available info. If you look at the 2012 cycle, where we have seen another contractionary year, market was dipped to a lowest level in recent history. The market PE was standing around 11 times. Where we have seen the foreign interest, and again the rebound was happened, right? And we are close to that particular historically low PE number. So I think, as you said, the foreigners have been gradually collecting, gradually accumulating. So that's a good sign where the value investors are still active in this market. True, the thin volumes are there, true, but still it's a gradual collection really reflect a sort of attraction with the current valuation numbers. So in that context, I would say the problem or the concern would be the opportunity cost. As you said, definitely the investors are having a good opportunity to bargain hunting the very discounted stocks at this particular point, but still the relatively high holding period would be, as you said, that could be covered through the high dividend yield stocks and all, right? Thank you so much, Usama.
Pleasure to be here.
So it's a very informative discussion today, and thank you so much for viewers at home. Bye bye.